Good morning, everybody, and welcome to those who are joining us online. Thank you. My name is Julie McCarthy. I'm CEO of NatureFinance. I'm really excited to welcome you all here today to this event on insurance and sustainability-linked insurance and reinsurance solutions for resilience finance. I'm going to give just a little bit of an intro to the topic, and then I'm going to introduce our panelists and kind of the run of show for today. So recognizing right now that we have got at least 7 trillion per annum in finance, or around 7% of global GDP, that is actively harming nature as we speak, and that without dramatic change right now, we are on course, according to IPCC scientists, for 2.5 to 3 degrees warming. We know that there's an extraordinary amount of underpriced, under-recognized nature and climate-related risk in our financial and economic systems that we're only beginning to truly come to grips with. Of course, we're seeing these risks intensify on a daily basis, putting growing pressure on insurance and reinsurance markets, as well as sovereigns at all income levels, from emerging markets to advanced economies, to be able to adapt. We know that rising losses are making coverage unaffordable and inaccessible in certain instances, especially in the global south, where there is a huge protection gap, including for many public utilities like power and water that remain uninsured. We know that low and middle income countries' economies are disproportionately affected by losses related to nature and climate, especially in sectors like agriculture that are big sources of livelihoods and export revenues. A large proportion of populations in low and middle income countries rely on natural resources for livelihoods, making them more directly and personally vulnerable to climate-related disruptions. And we know that insurance penetration rates are significantly lower in emerging markets and developing economies. Just to give a few examples, the infrastructure losses from Cyclone Freddy in 2023 in Mozambique and Southern Africa ran into the hundreds of millions of dollars, with almost all of those losses uninsured. The 2022 floods in Pakistan wrought around 30 billion in damages. Only 100 million of those losses were insured. For the Amazon rainforest, with all of the fires happening over the past several years alone, millions of hectares burned, enormous biodiversity loss of carbon sinks that are degraded, no insurance for so much of the environmental and community damage that has ensued. We know there are incredibly high startup costs and infrastructure requirements to make insurance work, especially in low and middle income countries. We're going to hear more about that today. But we also see these challenges increasingly in advanced economies as well, whether it's wildfires in California and Canada, flooding in Spain and northern Italy, heat waves in southern Europe, eroding both market stability and also public resilience. So today's session is meant to really confront these challenges head on and explore whether there are really underutilized opportunities to use insurance and reinsurance mechanisms to scale nature and climate risk reduction and associated finance for resilience and adaptation. So we're going to hear today from several colleagues who have been at the forefront of innovation in this domain at both the micro and the macro level, where new insurance products are tied in really interesting ways to measurable sustainability and resilience incentives. This includes everything from thinking about new forms of sustainability-linked sovereign debt that are tied to closing the protection gap in emerging markets and developing economies, to exploring the linkages between crop insurance premium subsidies and transition to regenerative agriculture, to parametric insurance products for vulnerable workers who are taking proactive measures to mitigate climate risk. There are some incredibly powerful and creative interventions here that are at the nexus of insurance, resilience, and finance. And there is a huge need for more coherence and scale and leadership in this domain to drive the change that we need. So we are delighted to be able to convene such an extraordinary group of leaders today to explore some of these early proof points and think about how we scale interventions in this space. We're going to show you first a video from Robert Eigenheer, who's chairman of SBB Insurance, the captive insurer for the Swiss Federal Railways, who couldn't be here today, but really wanted to share this groundbreaking story of the first major sustainability-linked commercial reinsurance contract. We're then going to have my colleague Arend Kulenkampff, who leads our work on innovative finance, share a bit of deeper framing on this emerging area, sustainability-linked insurance and reinsurance solutions. And then we're going to have some lightning talks from some innovators in this space. We're going to have Dr. Olivier Mahul, who's the global manager for climate finance mobilization at the World Bank. We're going to have Kathy Baughman McLeod, who's CEO and founder of Climate Resilience for All. And we're going to have Paula Pagniez, who's the executive director for climate risk and resilience at Howden. Then we will hopefully have a chance today to actually do some Q&A with the audience and have a little conversation with the panelists. So with that, I think I will cue our video.
Yes, just a quick disclaimer for the participants online. Thank you for being with us. We don't know if this video is going to translate the sound across for them. That's why we have subtitles, but if it all goes wrong, we'll send it to you after the event and yourselves as well. Thank you.
Preemptive apologies.
Dear participants of this year's London Climate Action Week, let me start by thanking NatureFinance for giving me the opportunity to briefly introduce our groundbreaking initiative we launched last year at the Swiss Federal Railways in collaboration with 3 major insurance companies, a sustainability-linked insurance contract. My name is Robert Eigenheer and I run the corporate finance department at Swiss Federal Railways SBB, where I'm responsible for treasury, insurance and M&A activities. Additionally, I'm the chairman of our direct insurance captive, SBB Insurance, based in Liechtenstein. Prior to my current roles, I led capital markets, treasury and investor relations at a multilateral development bank. So I've had the privilege of working with a wide range of sustainable finance instruments in financial markets. When I joined the insurance sector as the chairman of SBB Insurance, I asked my team, what is this section doing in terms of sustainability? The answer was quite a lot on the asset management side, but surprisingly little on the underwriting side. And that's where we saw an opportunity for real innovation. Our idea was simple. Take the well-established concept of sustainability-linked loans or bonds and adapt it to the insurance contracts. So how does it work? Instead of tying sustainability performance to interest rate, we link it to the insurance premium. And thus, the sustainability-linked insurance project was initiated. This concept follows 5 straightforward steps in order to align your insurance contract to sustainability. First, choose the right key performance indicator KPI. Start by selecting a meaningful KPI that aligns with your organization's and insurance sustainability goals. The KPI should be measurable and influenceable by your organization, as well as already exist as a KPI. Common choices include CO2 emissions or ESG ratings. Second, set an ambitious sustainability performance target, SPT. Next, define a SPT based on your selected KPI, even if your overall sustainability goals extend to 2030 or beyond. Insurance contracts are usually short-term. Use a top-down target where you break long-term targets into yearly goals or define the targets bottom-up, where you aggregate the impact of specific projects. Both approaches are feasible to set meaningful short-term targets, but make sure they are ambitious. Third, adapt your existing insurance contracts. Work with your insurance to integrate a bonus penalty mechanism into your insurance contract, linked to the target achievement of your sustainability performance target. For example, if you overachieve your emission reduction target, a bonus may apply. If you do not achieve the targets, a penalty may be enforced. This payment can be structured as a percentage of the insurance premium, which then must be allocated to sustainability projects. Fourth, report transparently. Make sure to report your chosen KPI and progress towards your targets. This keeps your organization accountable and enables tracking on sustainability progress. Fifth, Verify with a third party. To ensure data accuracy and its credibility, have your sustainability metrics audited by a third party. You can either extend your existing internal auditor's mandate or engage a specialized firm for second-party opinions. Verified data is a must for stakeholder confidence and ensures that bonus penalty payments are based on reliable evidence. In conclusion, our 5-step approach transforms a traditional insurance contract into a sustainability-linked insurance, directly supporting the sustainability strategy of the insurer as well as of the insured organization. So why I'm speaking to you today? Because we need followers. If we want to generate meaningful environmental impact, this initiative needs more organizations that join this journey. Scaling is the only way to truly accelerate the positive impact of this solution. We need insurers who are ready to innovate and to include such a product into their offering. We need corporates who are willing to connect their sustainability commitments with insurance contract. We need both for the benefit of an environmental impact. Thank you very much for your interest in your sustainability-linked insurance concept. Unfortunately, I was unable to join you in person today for this panel discussion. However, I look forward to future opportunities to connect, and I'm always happy to follow up bilaterally if you would like to discuss further. Let's stay in touch and let's drive this forward together. Thank you very much.
If I was the annoying person emailing you all to confirm attendance, so if any of you do want to follow up, please reach out and I will directly put you in touch, I promise.
Thank you so much. And Robert, if you're listening, thank you so much for that really fascinating case study. And one of the things that I think is really compelling about what he shared is that you're able to take existing contracts and adapt them in terms of barriers to entry. This isn't about sort of reinventing the wheel and issuing a whole new structure, but layering upon a system that already exists, which I think is really exciting. So with that, I'm going to turn to Arend to help us lay out a bit more of the landscape here on sustainability-linked insurance and reinsurance.
Thank you. Good morning, everyone. Thank you, Julie, for that opening, and thank you, Robert, if you're online, for that really powerful and compelling case study. So what I'll try to do is not take too much time away from our panelists, who are going to talk about all the interesting and new innovative products that are coming out in the insurance space, including from what we heard from Robert, but to kind of give the bigger context and why this is so urgent at the moment. So if we can see the next slide. So this is a framework that we're using to conceptualize the role that insurance is playing in the bigger picture of the poly crisis, the nature climate, sovereign debt crisis that we work so much on at the sustainability linked, the Sustainable Sovereign Debt Hub and at NatureFinance. And really, insurance is deeply implicated in this dynamic. And I'll just very quickly walk through how. So as we know, there are these escalating shocks from climate and nature loss that are putting increasing pressure on not just corporates, but governments as well. And there's just, that's translating into reduced budget space to be able to invest in the kind of adaptation and resilience infrastructure that is needed to protect ourselves against these losses. And of course, insurance is an important part of that adaptation and resilience story, right? It is effectively, insurance in a way de-risks the sovereign balance sheet, as we like to say. So any kind of losses that are picked up by the insurance market in the private sector and reinsured into international markets is a fiscal cost that the government does not have to necessarily assume. So insurance is adaptation strategy. But what we're seeing, of course, is that as these losses escalate, as the expected losses that insurers are seeing deteriorate, their ability to provide insurance at affordable rates is also diminishing, and they're pulling back from exposed areas. So my sister, for instance, lives in California. She was very exposed to the Palisades fire. Right now, she has lost her insurance coverage. Last year, it went up by 700%, and then this year they just said it's over. you have to go to the state reinsurance pool for your cover, the state risk pool for your cover. And then, of course, that compounds these effects that we're seeing, and the ability of governments who are now having to spend more on disaster relief and recovery have less budget to invest in mitigating and adaptation strategies. So this is the challenge that we're facing, but we now have this tremendous opportunity from repurposing the insurance products that are already out there in the market, from established covers such as forest cover, and we're going to focus specifically on nature, from forest covers to business interruption insurance, from new parametric covers that we'll hear about from the panel, to this new generation of sustainability-linked reinsurance and insurance. And people who know me know how excited I get about KPIs, and having a background in reinsurance, for me, this was really mind-blowing to have these types of innovations. And I think we have an opportunity here, from having learned from the experience of the sustainability-linked debt market, to kind of avoid some of the pitfalls that we've been seeing, the challenges that we've been facing in those in the debt markets as it might apply to insurance. But finally, what we need really is to achieve scale, as Robert so rightly pointed out. And so there's also an opportunity here to take insurance as a concept and apply it into some of the broader policy discussions that we're having separately around the global financial architecture and sovereign debt crisis that we're facing. So the work that we're doing at the Sustainable Sovereign Debt Hub and at NatureFinance is also looking at this concept of the protection gap, which is simply the losses that we are all exposed to and that we'll be increasingly exposed to as a result of climate change and ecosystem collapse, and the protection that is in place. And because of the cycle, as I described it so briefly, that protection gap is just growing and growing and growing. So what we need to do is we need to elevate this in the policy discourse and make it a political imperative and a policy priority for governments to take seriously. And one way that we can do that is to create this target and a key performance indicator that is the protection gap. So imagine a government who issues a sustainability-linked bond or takes a loan and says, I commit to closing this protection gap through interventions like fostering insurance, deeper insurance penetration. For instance, there are a number of policy interventions that can be deployed. So requiring insurance on mortgages and property catastrophe covers, providing subsidies to smallholders for crop insurance. Really, the gamut of opportunities is quite broad. And what we want to do is create an additional incentive to reward governments who undertake this action by giving them, in that case, sort of a relief and improvement in their borrowing terms. So as I said earlier, the way that we look at insurance is that it's fundamentally also a sovereign risk solution. And deepening insurance penetration can then also reflect positively on sovereign creditworthiness. And then, of course, the important work that Olivier Mahul is doing at the World Bank around disaster risk finance is also a tool, a solution that sovereigns can and should take more advantage of, not only to de-risk their sovereign balance sheet, but also in this instance, if it were to be part of a KPI and target, to help them drive towards achieving that target and realize some of those gains and those rewards that might be forthcoming from narrowing the protection gap. So, that's kind of the broader scene setting as I wanted to lay it out. And really now it's about hearing where are we finding those pockets of innovation that are going to help us close that protection gap and get us to where we need to be, and to halt and hopefully reverse this vicious cycle that we're all currently trapped in. So with that, thank you very much. And I would call the panelists to the stage now.
Please.
I think anyone is fine, right?
Yeah. And you should hang on. There's no particular order to start in, so why don't we just go down the line here? And Kathy.
I've got the mic.
Yeah, you got the mic. Why don't you kick off and tell us about the work that you've been doing and the innovative approach that you've been taking?
Well, if you came to a Friday morning session on insurance, you also love insurance. So I'll start by saying I love insurance as a tool to solve climate challenges. And so do you all. So this is a sisterhood, brotherhood happening here that it's
Awesome.
yeah, after a big week. I'm Kathy Baughman McLeod. I I'm the CEO of Climate Resilience for All, and our mission is to support the health and livelihoods of women facing extreme heat. It may sound niche, but there are 800 million women in the informal sector in a very hot band around our planet. And we are physiologically disproportionately impacted by extreme heat, and then by inequality, by culture, by social standing. Women are then gobsmackingly disproportionately impacted by extreme heat. And thus, we know that if we want choice and opportunity and agency for women, which is good for everyone, and at CRA, our motto is when women are climate resilient, we will all be climate resilient. And I have a sticker that says this, and if you want a sticker, please see me after the session. I will give you a sticker. We know that if we want that, women need money and women need income, and heat is evaporating women's income. And there's a lot of reasons for that, and I hope we're going to have a chance to do that. But when you have this kind of risk, and the risk is so epic for a community, for a family, for a local and regional, and I would say global economy, when the informal economy is 92% of India's economy, we need to understand that risk, reduce that risk, and transfer that risk. And so we have developed a product and a program called the Women's Climate Shock Insurance and Livelihoods Initiative. We are working on the marketing of that very jazzy title. So WCSI for short, come back with something a little more palatable, but nonetheless, it doesn't matter because what it does is support women's lost income in the face of extreme heat. It's a parametric. We have 225,000 women on risk today for this heat season. It does have cyclone and excess rain in the policy. Swiss Re is our partner. We have also partnered with the Self-Employed Women's Association, which is a labor union of informal women workers, 3.1 million women. This is, last year we had 50,000, and the women are in the most heat exposed trades. And those are construction workers, home-based workers, ship breakers, head loaders, market traders, street vendors. I'm missing a couple of them, but you get the idea, very heat exposed, and their health is being diminished, and then they go into debt. And we could have a whole panel on that, but the point of this is the interesting instruments that we're using to try to support their income. When the temperature hits a certain level, a payment goes directly to their bank account. They are all banked, so there's a financial inclusion element here. And we also included a social protection layer of 2 days of income that triggers at a lower temperature. And then we have an early warning system that was co-designed with them. That's the lowering the risk part. And then we have other physical risk reducing interventions. So we want to reduce the risk. Women can hold only so much risk if you're making $3 a day, and then we transfer the risk. And so last year, 92% of the 50,000 participants had a payout between $7.83 and about $20. And all of them had the social protection layer of 2 days of income. And that went across 23 districts in 5 states. And so it's showing early success. And the stories that go with the use of this product, you can see that the money's being dispersed, and that is good. But we learned some unexpected benefits, and a couple of those benefits included being creditworthy again in the community. One woman, and I hope I'll get another chance because I know we need to keep moving, is about a woman who said, I bought back my dignity and self-respect. Yes, there are lots of incredible stories of impact. And so we want to continue to innovate. There's some real challenges with this product, and that's probably another hour session. But anyway, I'm delighted to be here. Thank you for inviting me, and I will hand this very precious mic away.
Thank you so much, Kathy.
Wonderful. Thanks very much. And thanks really for the invite. So I'm Olivier Mahul. I work with the World Bank. I've been with the World Bank for 20 years. Right now I'm leading the climate finance mobilization team. But in my previous job, I used to be the manager for the climate risk finance team at the World Bank. So this, of course, this topic is very close to my heart. So I was very happy to be invited even on a Friday morning to join you. So a couple of points maybe from the World Bank perspective, just again, since I'm working a lot on climate finance, again, to highlight the climate finance gap And if you take some big numbers, the gap is even bigger, of course, for developing economies, which on average receive 16% of the total climate finance, although they do represent more than 25% of GDP. So clearly, developing economies are underserved when it comes to climate finance. And out of this number, only 16% is dedicated to adaptation. And 98% of that come from public finance. So you can see the big gap, the wide gap, in fact, the growing gap when it comes to private sector or private capital mobilization to adjust adaptation. So the bank is a development bank. So we do care about this topic because it does impact people. Women affected by heat waves, households affected by floods in Pakistan recently, or even by earthquakes if we go beyond climate events. And the bank has committed 45% of its lending towards climate finance. And out of that, 50% is for mitigation and 50% is for adaptation. Adaptation, both physical adaptation, I would say, and financial resilience or financial adaptation. So we do a lot of work in investing ex ante, making sure that, when we build roads, when we build infrastructure, when we build schools or hospitals, they are, I would say, climate proof. But of course, it's never enough. And when we deal with the residual risk, that risk that cannot be fully mitigated, then this is where insurance and other financial services will kick in. So within the bank, as a development bank, we have developed what we call our crisis preparedness and response toolkit. So a series of financial instruments that aim to help Ministry of Finance, since our main client are governments, to deal with the potential impact on their fiscal balance. Just to give you a sense, on average, a low-income country will lose 2 to 3% of their GDP because of disasters. It could be more than 100% if you take big tropical cyclone hitting a small island. But it's a significant impact on their growth. Are they trying definitely to grow? And if, of course, every year you have to take a cut of 1, 2% or 3% of GDP because of disasters, this is definitely a kind of move backward. One of the tools we've developed, which by the way nicely complements insurance products offered by the private sector, and I will go back to that later, is a line of credit. So making sure that governments can sign beforehand a line of credit they can access within 24 hours following a disaster. And we're not using parametric triggers. In that case, we're doing a soft trigger, which is the declaration of disaster. So if you face a big event, if the government decides to declare emergency, which has a political cost, so they are very careful when they declare emergency, then they can access some funding, release 24 hours, which is budget support. This is very much to meet with their emergency needs. We're not the only one doing that. Other development banks, ADB in Asia or IDB in Latin America, are also offering this kind of products. This is, I would say, the entry point for most of our clients to deal with financial resilience, because they're bankers, because we're a bank. So this is the kind of product we offer. More recently, we also offered a new product to what we call a climate resilient debt clause. So in case of a disaster, giving the opportunity for the borrower to pause on the repayment of their debt in order to redirect for a couple of years the repayment of the loan towards emergency response. Again, it's not a perfect tool. It's a toolkit. Right now, about 21 countries, mainly low-income and small island states, are using this kind of debt pause. But this is also something that is part of this kind of toolkit that can access, again, to free up resources following a disaster, not rebuild, very much respond to emergency needs. The reconstruction phase will take longer, and there are other instruments, most likely ex-post instruments, to some extent lending, to some extent to rebuild, but at least making sure that they can face with their emergency needs. Now, having said that, the public funding coming from the multi-development bank like the World Bank and others will never be enough. So we need to find a way to bring more private capital. How you do that? I mean, insurance companies are not philanthropists, so they need to have a kind of good investment on the return. It has to make sense for them. And although when I started at the bank, we did a lot of parametric insurance pilots in Asia or in Africa, and we've been able to mobilize insurance and reinsurance companies, including Swiss Re and others, on a more I would say, corporate sustainable basis. So it was a kind of nice gesture for the insurance companies to come in, which is good. But of course, we want to scale up. It has to make sense from business perspective. So this shift, moving from small pilots to look good, moving to a business that makes sense, is something to take into account. So you know the numbers, you know about the protection gap, and I guess we can discuss that further. The protection gap exceeds 90% in most of the European economies, so 90% of the losses are borne by the individuals at the end of the day. And those numbers are even bigger because, of course, in most of these countries, you don't have any kind of social safety net to some extent to protect the most exposed. So they're very much bearing the costs, and we've seen that again in Pakistan or in Mozambique and in many other countries. So the way we've been trying to address that is, again, to mobilize private capital and to find the right balance between public intervention versus private intervention. And again, the point is not to replace what the private sector can do, but to create the kind of right enabling environment for the private sector to step in, but also to make margin and to make profit, because this is more or less what they should do anyway. And what we've been doing is focus on 3 key pillars. The first one is to build the right, I would say, market infrastructure. Access to data, not only hazard data, which usually are easy to access for most of the insurance companies and private sector, but exposure data. Where are the assets, how much they're worth, what kind of assets they are. So those kind of data are quite important. In some of the countries also, we helped countries develop their own cat risk models. It's pretty heavy upfront costs. The private sector may not want to invest in those kind of models in low-income economies simply because they don't see the business opportunities in the near future. So we've helped countries to develop these kind of models, then run by the private sector, at least to kickstart the process. And also trying to pilot parametric products or other kind of insurance products to again to make sure that we can find some cost-effective solutions. The second pillar, which is very important, is about the legal and regulatory environment, making sure that the governments can create the right enabling framework to attract insurance companies, including domestic insurance companies. So having the right risk-based regulatory framework in place, making sure that you want to attract domestic insurance companies on a business like catastrophe insurance, but at the same time, this is very, I would say, capital intensive. And you don't want to end up with the worst case scenario, which would be a government, I would say, incentivizing domestic insurance companies to offer catastrophe insurance. And then those catastrophe insurance companies got bankrupt because they don't have enough capital. So it's very important to find the right balance between, I would say, growing the domestic insurance market, because it's a lot about domestic capital mobilization backed by the insurance industry and the international insurance industry, but at the same time making sure that when this insurance product is sold, there will be very high probability that payment will be made on time. And that the question of trust in those developing economies or regarding insurance particularly is pretty low. So you need to build trust. And when you deal with catastrophe insurance, which needs not aim to be paid every year, building trust through payouts is something that will take some time. And the third one is, again, to help those countries to have the right vehicles to access a private capital. This is my third pillar. It could be by helping countries set up some insurance pools. So we've done that at the national level in Turkey, for example, 25 years ago now for earthquake. We've done that at the sovereign level in the Caribbean for small island states in the Caribbean, in the Pacific, in Africa as well with the African risk capacity, as well as more recently in Southeast Asia. So this is very much a way for countries to join forces and to approach the market in a more structured way, making a better, I would say, value proposition to the private sector, and hoping, of course, the premium to be lower. On top of that, some countries can directly access the capital markets. We helped through our World Bank Treasury countries access cat bonds. A recent cat bond was for Jamaica, $150 million cat bond. Again, trying to complement to some extent their toolkits, including national reserves, access to insurance through the Caribbean pool, and also going to cat bonds. And I'll finish by the last, so it was many high level. Now, if I go to the mic, if you give me one more minute. 1 minute. Just to maybe close on what you just said. We also, while we're working a lot at the macro level, we're doing a lot of work at the micro level. So we have a very interesting initiative in Africa, where we've been helping herders pastoralists to get access to a livestock insurance product. And what was interesting here, it was very much linked to the kind of broader financial inclusion approach. So we've been offering them a combination of savings and an insurance product to protect them against a drought. So 2 million people now covered, 56% are women. So again, this kind of financial inclusion and bringing these kind of financial solutions down to the individual is also something that we're very, very careful about.
Thank
Sorry
you
to
so
be so
much.
long.
Not at all. All very interesting and important work. Paula, please.
Thank you. So good morning. Hello, everyone. Yes, Friday of Climate Week. It's amazing to see all of you in an event on insurance. And let me tell you why. I've known these wonderful human beings for a long time. I've had the blessing of knowing them for a long time, and we've been pushing innovation, everything you've been describing, and KPIs to register it for a very long time. But it was only on Monday this week that we had the second edition of the De-risking Summit to talk about the crisis of insurability, and having that as a flagship event, opening London Climate Action Week with 1,000 people enrolled. I think we reached like 600 in attendance during the day, 400 online. Mm-hmm. When has insurance been sexy? Let me tell you, I work in insurance. I don't think insurance is sexy. What's sexy is the use of insurance because of what we need to do in terms of climate finance to incentivize the allocation of capital to support the transition. So when we watch the video today, to me, I mean, it's phenomenal. And yes, this innovation has been deployed over the years. Olivier, you just walked us through so much work. I mean, as you were talking, I'm thinking, wow, we've been doing this for so long. But the issue is scalability. Now, when we have a solution like the one you saw on screen, presented by the head of corporate finance of an organization, now we're talking. Now, climate insurance is part of the financial solutions that corporate organizations are starting to incorporate into their business models, not for growth, for business sustainability. So when we talked about the insurance crisis on Monday, and you can look for the insurability report, hopefully we're pushing it enough online, but you can see the numbers. And yes, if what we've been demonstrating with pilots doesn't scale up and doesn't reach the corporate sector because it makes business sense to invest in adaptation and resilience, and because it makes business sense to use all the tools that we have in the financial markets in order to accelerate it, because otherwise it's not only sovereigns that need to use all these tools to respond fastly to the impact of disasters. Sovereigns, based on the example you mentioned in California, sovereigns have been absorbing the cost of disasters. And just look at California. The same thing is happening now at the state level. So there's a key role for the private sector and for corporations to come together to talk about the insurability crisis, to acknowledge the impact that climate risks are starting to have. It's starting to become evident in housing markets and in agricultural markets, which relates to food security. So in that very happy note, I'm going to pass it to Arend. Thank you.
Come back to me. Yeah, actually, I don't need it. You keep it. Someone come back to you. Thank you so much for that first round of interventions and table setting. There's a lot to get into there, and I'm sure there are a lot of questions. I'm going to take advantage and abuse my mic to do just one round of questions with the group and then open it up to the floor here. So, Kathy, we had a really fascinating conversation when we had the pleasure of meeting recently, and you talked me through the full landscape of, I think, not very well understood often impacts of extreme heat from the micro sort of individual
Yeah.
level through to the sort of corporate labor force implications through to then economy wide. And I wonder if you could just sort of share a bit of that story. And also I had a question about better understanding just a little bit more the sort of financial instrumentation of the insurance product that you developed. Thank you.
Well, and I should have started, because this is a Nature Finance, I should have said I was at the Nature Conservancy for 5 years and launched the Nature Conservancy's Insuring Nature program in 2017, maybe, a long time ago, Paula. Thanks for aging all of us, appreciate that. And started thinking about how does risk transfer work to finance protection of the reef, because the reef is protecting us. And so have looked at insurance for a long time, and then also worked in the chief financial officer's office in Florida. So big institutional investments and risk and such. And so from the macro and the sovereign to the micro. And so you asked about the impacts, and I think all of this is so beautifully woven together. So well done on choosing your panelists. But the impacts are, and this is one of the things that we're trying to do. We're just out of time. I mean, Paul is right. We're just out of time. And so saying things like negative health impacts, we just don't do that anymore. We say urinary tract infection, rash, miscarriage, headaches, heat stroke. We're using real words to describe the way that climate is affecting people. Our focus is women. And so those impacts have huge implications for her income, because you have renal failure, you pass out, and then you have to get hospital care, and then you go into debt to get an IV, you've broken your leg. This is a specific story about a head loader named Gita. She can't wait inside. She has low social status, so she can't just to stand in the sun to wait for her client to call her to move her next load of fabric. She's also financially responsible for half of the value of the fabric she's carrying. So if she falls, which she did, she had a head injury, broke her leg, the fabric gets soiled, she owes her client half of that. So she has to go into debt to pay that. She is in debt to the hospital. She can't work because her leg is broken in a cast, and so she doesn't have enough money for food. So what this product did is pay her on the days, every day, that the temperature was at the preset level, and those are different given the weather basin, and there's lots of details on the policy itself, and we can talk about those. But in essence, she was able to pay the hospital debt and the cast and most of the debt to the client, and was able to eat for the 3 or 4 weeks that she was off, and then she could go back to work. And so, of course, we don't want to just have Gita Ben just getting back to zero when she gets back from being injured and having a little bit of debt. We'd like for her to be on top. We'd like for her to have more and be having more choice and more opportunities. And so I think it's interesting when you're talking about risk, so much of the climate transition conversation is about what's above the line, what where the cash flows are, and what the opportunity is for investment and return. And the conversation and focus on risk is essential, because and we're experts at extreme heat. Extreme heat is draining economies. And so take her example and amplify that. If you do informal workers, that's 800 million. If you added low income working women, that's 1 billion women. And so in August, well, it'll probably be September, we're going to be releasing an analysis of what we'll be projecting women like Gita Ben's experience onto the regional economy, and 1 woman on every continent, so that we could see what the economic effects are, and projecting the interventions that reduce the risk. So shade and early warning systems and microinsurance and cool roofs and I think there are 6 big interventions that we'll be modeling. If you invest in these, this is what how the economy benefits from this. And so we can talk about infrastructure and melting railways. And I mean, this is happening here. This is no longer just a conversation about traditionally hot places in the global South. And so in every aspect, in healthcare, workforce, supply chain, thinking about the effect to the US economy is $200 billion every year in worker productivity losses alone. That's not business interruption or healthcare or infrastructure. That's just one category. And of course, 18%, 20% of that is disproportionately borne by Black and Hispanic workers in the South. in Bangkok, it's 8% of the GDP. Every worker in New Delhi loses a quarter of their income from heat. So first we have to understand it and have the quantification. This is not new. I mean, this is not a new idea, but I think when we have the director of finance, as you said, and economic projections that are going to begin to show the melt of the
Quantify it.
growth and
Yeah.
quantified, we need for Gitaben to be protected. That protection gap starts right there. And what it means for her children and for her community, when we know that women put 90% of what they make back into the community, men's number is less. I'll tell you after what that number is if you want to know. And you probably know these numbers, but this is investing in women for climate adaptation is good ROI. So
Yeah.
is that what you were looking for?
Yes,
Yeah.
absolutely.
Okay.
Thank you. And wait, before we move on, can you talk a little bit about the partnership with Swiss Re and sort of how the
Yeah.
structure, the product is structured?
I also want to point you all to something. We realize that in the world of adaptation finance, there are lots of tools like the taxonomies and the playbooks. And one thing we found is that a lot of the mitigation finance team said that they knew about adaptation finance, but when you got into it, not really, and that a primer would be helpful. And so with Emily Mazzacarati, who is the founder of Tailwind and the founder of 427, a climate resilient climate quantification company that she sold to Moody's. She's on the board of Climate Resilience for All. We co-created an adaptation finance primer. And my point is that we interpret the capital stack through the lens of people. And so the capital stack includes household spend, and that's the biggest category, and loss and damage funds, and disaster risk financing mechanisms, parametrics, et cetera. And so if you think about this product, we have Swiss Re, ICICI Lombard is the local cedant in India, and Climate Resilience for All is the architect to put the pieces together, and the women, the insureds, are putting in 40% of the premium. So you have household spend as part of the stack, philanthropy as part of the stack, and risk capital as part of the stack, because ICICI Lombard and Swiss Re share that risk. And so I think it's good to give those examples. What do they look like? And then, think about the scale of if 225,000 now, and then what that means for their credit worthiness, what they're spending in their communities, et cetera. So
Yeah, amazing. Thank you so much.
you bet, you bet.
Oliver, my question for you has to do with your take on where sort of broader development finance institutions, including but not limited to the World Bank, are right now in terms of, a very heavy focus on disaster response and emergency response. And you mentioned some of the interventions, lines of credit and climate resilient debt clauses and so on, versus how you're thinking about prevention and what kinds of conversations are you having in terms of, for example, with infrastructure investments and agriculture investments, like where risk and resilience come into play in that domain in the context then of also thinking about all of the insurance challenges that countries are experiencing on the back end of climate and nature risk?
So, no, that's a very important point. And I should have started by saying, in fact, most of the work we're doing is very much about ex-ante prevention. So a lot of the investments we're making are very much to protect before disaster occurs, whether it's public infrastructure, whether it's ultimately people. So we're dealing on the financial side, we're dealing simply with this kind of residual risk that would be too expensive to try to protect through higher dikes or stronger buildings. So it's always a kind of fine balance to find. Now, having said that, again, from a government perspective, particularly, insurance is valuable not only in terms of the ultimate number, but in terms of access to quick liquidity. And this is where, even when you think of this kind of timeline issue, of course, you want to invest as much as, you want to invest ex ante to protect your buildings or your assets, your people, ultimately. And if you get hit, there are main phases. One, you want to make sure that you can have access to immediate liquidity to face your emergency needs. And then the reconstruction phase will come slightly later. Of course, will be the most expensive one. But the critical, I would say, window is very much the few weeks following a disaster, where the government needs to have access to liquidity to pay for their emergency and early recovery needs. And this is where this kind of gap is. So insurance is one, not the only one. It can be quite expensive, and this is usually the answer we got from Minister of Finance. You know, it is expensive. So is it less expensive than line of credit? It depends. Is it less expensive than waiting a bit longer and expecting donors to come? Sometimes, yes. So again, it's very much this kind of strategic approach we're trying to have with them. And to some extent, the innovation, if I were to be a bit provocative, is less about the product itself than the way the clients, our client government will, at the national, sub-national level, or even now the individual level, will be able to combine those instruments. So as I mentioned, I was finishing with the example, and I had to rush because it was quite long in my previous answer. The program we're having in the Horn of Africa, when you help pastoralists design some sort of kind of financial mix of products, anchored around livestock insurance, but also incorporating some savings, but also access to finance, access to bank accounts. For us, this is the kind of package you need to have. It's all about financial inclusion. And interestingly, it's benefiting mainly women, in that case, more than 60%. And also the way you present it, a small anecdote, when we were meeting with the herders and pastoralists in Kenya, when you talk to women particularly, when you talk about livestock insurance, it does not always resonate with them. If you tell them, look, we're going to help you have a product to protect your family, your households, goes beyond livestock, protecting the asset itself, it resonates much more with them. So it's also a way to package the product and to make sure that then you can address their needs. And last point, just point to what you made about heat, it's all about jobs. And as you know, those days in the bank, there is a strong focus on job because it's about dignity, it's about livelihood, it's about income revenue, and you need to protect, once you need to create the jobs, and you need to protect those jobs. And one way to protect it is definitely to have some financial instruments, including insurance, as you mentioned, for heat waves, but also for floods and other types of disasters.
Thank you so much. Paula, I'm curious to hear a little bit more from you. You know, you talked about how we have so many proof points, and you've been doing this work for so long with colleagues on stage here. And there's so many great stories, and we're just sort of arriving at this moment where people are reckoning with the insurability crisis. I would love to hear a little bit more about what you see as kind of what the barriers to scale have been thus far, and where you feel like this conversation needs to be showing up in different kinds of forums, and where the leadership needs to come from in order to move this into the mainstream in a way that we haven't seen, and that especially in the corporate world needs to be reckoned with.
Okay.
Does that come from voluntary action in the
No, I'm
corporate
just
sector?
trying
Does it
to
come from
organize.
sovereigns?
There's so much.
I know.
When I say we've been doing this for so long, personal story sharing. We were at a FEMA National Advisory Council meeting with Kathy about, what was it, 2 weeks ago? 2 years ago. Yeah. She told me I'm a veteran of parametric insurance. My heart skipped a bit. What do you mean a veteran? And I'm still trying to I'm still thinking about it. So it's like, yeah, it's been very long. And yes, great investment, great skincare, and keeping close to your friends that are not going to give up. So variance
Resilience.
Just those who see it, and all of you here in the room, let's keep the dialogue, because we need more people that see the potential of this. And now that there's more case demonstrations on how to use it. But okay, so a lot of what we have demonstrated through pilots, it's at the macro level, on parametric insurance for disaster risk finance for sovereigns, for countries, or at provincial, local level, coalitions of cities, etc. A lot of what we have demonstrated, and Kathy has walked us through the details of the impressively impactful work that you guys are doing, it's at the micro level. Now, I'm gonna say it, as the global north turns into the new global south with the impact of climate risks, we have the opportunity to use the tools and metrics, KPIs, and methodologies that the private sector has been using to understand and measure risks. Kathy, what you were talking about, putting economic and financial numbers on the impact of climate risks into our economies. So if we continue trying to grow this only, and I'm not saying please we stop, it's only working in the global south where there's no other alternative. So actually the take up of these solutions has been in a way easier or faster, but it's not because the conditions there are better for it. It's because there's no alternative solutions. And therefore, using parametric insurance for the fast injection of liquidity that Olivier was walking us through was the only way. And it has allowed us to demonstrate all these concepts in areas that they really needed. What I think that's happening, I'm going to go back to the example of California, is in all these cases, we've been trying to incorporate, bring in insurance as a new tool to solve a problem that otherwise was not being solved. We have the other problem we're dealing with now, and this is the insurability crisis. It's not only bring insurance, it's when insurance pulls out for certain markets because the risks are so high that in order to cover them via risk transfer mechanisms, if you're going to have to pay a lot of people, inject that quick liquidity for a risk that manifests itself extraordinarily, there may be not enough premium to make that equation work financially. So we need to act before we get to that point. And that is where a ton of the innovation is happening. And the innovation is happening in how we use these tools. So for example, and going back to quantification, at the end of March, we launched a report commissioned by the European Investment Bank. And this report was all about using the methodologies used in insurance in order to first clean up the data and generate clean data series of the main crops grown across the EU, create the models and climate condition the models so that we can then do projections on what the crop yield losses are going to be between now and 2050 for the different climate scenarios. Sounds like the type of work we like to do on quantification and put a ton of metrics, but what does it mean? And it is Friday of Climate Week, and I forgot my notes, so I'm not going to give you numbers. Craig might remember them better than me, actually. But what it means is, for example, in the EU, you have countries whose GDP is, for example, highly dependent on fruit trees. With climate change, we're seeing that spring is starting earlier, which means that trees are blooming earlier. But the frosts from the end of winter are still happening and still at the same time. So now you have early blooming trees that are faced with frosts. It impacts their growth and their productivity, and then comes the drought. So if this type of crop is 1% of the GDP, 8% of the GDP, or close to 30% of the GDP, my goodness, should we be thinking about how to make those economies more resilient? And that is a discussion that we're trying to bring on the insurability crisis in saying, we've seen the impacts of climate change for way too long. We've been demonstrating how to use these tools. It's impacting the global north as well, from California to Romania with fruit growing trees. In the Nordic countries, yes, in the Nordic countries, crops are not used. Well, I need to stop. No, these merits the full attention. In the Nordic countries, crops are not used to effing hot and dry conditions. So crops are not going to survive. So when we do this type of quantification and we ring the alarm, it's not because we like to be fatalist. It's because we are still on time to invest in resilience and adaptation, and the climate finance arena can give us some tools to do so. Last point, before I escape my mind. So in terms of the innovation, right? So we put those numbers out there. It's so scary. We're like, what are we going to do about it? We have these examples that have been presented. What other things are we doing? And Craig, I'm going to look a lot at you. We're collaborating a lot with the UN Climate Champions in really bringing some order and strategic priority to all the different projects we could think of. Imagine people like I have in the back of my mind 1,000 ideas of things that can be done, but we need to focus on those that are going to show results, right? As soon as possible, and involving as many different type of stakeholders as possible to demonstrate that this is doable and hopefully on time. So the carbon markets, for example, the carbon markets got started in different ways in different economies. What's most difficult about carbon markets is that if you look at the life cycle of a carbon project, you want to bring investors in, and you want to give these investors confidence that their investment is going to have a return. Now you have to wait until the natural assets, because we're talking about nature finance, the natural assets reach a certain maturity in order to produce the credits. That's many years. And there's so many risks in the life of that project. So what we have done is map out the life cycle of this type of projects and identify, to your point, Julian Arend earlier, what insurance products can we use in order to bring confidence to investors in these products? And the insurance sector has, for example, a warranty and indemnity contract or type of product that exists that is using in M&A that we tweaked in order to help bring credibility to the integrity of this credit. So you add in there performance guarantees, you add in there parametric insurance for the forests that are the ones that are being grown in order to generate the credits. Done. We have 2 demonstration cases. We're working in carbon capture sequestration in areas like the US, and granted, the new political situation is pulling out some incentivizing funding, but because it makes business sense, that's still growing. And in the EU, you have a lot of carbon capture sequestration that is growing. So this type of product solutions get stopped because there's a lot of liability issues that can occur from the emitters. The emitters need to trap the carbon, they need to push it into transmission lines, and then it gets stored for a long time. If I were to describe all the physics of how we need to manage carbon for that whole process to happen, it's crazy. It's like a whole day on physics and chemistry. And therefore, the different stakeholders that are part of that chain are like, well, but am I going to assume that liability? Well, then now this is a barrier, it's a disincentive. So we're using existing insurance products in order to respond to that liability and cover it and facilitating these value chains. I'm going to mention one more, which is we're collaborating with one of the biggest farming companies in the world and a wonderful company by a friend, Nate Matthews, I'm missing up his last name, yeah. Nate Matthews. Yeah, at this point, I don't know. Planetary X. So with the example that I mentioned on carbon credits, we're thinking of biodiversity credits. And what Planetary X is doing is actually helping with providing an economic value to the natural assets and helping generate with the guarantees that the insurance can provide, helping generate the credits that also not only help because we don't have to wait until the end of the project, but actually can bring a revenue to the owners or protectors of the nature assets on an annual basis. So if we think of farmers that are chopping down the Amazon because they need more land in order to produce for subsistence, if we can replace part of that revenue by one from a carbon and biodiversity credit markets, and it's not in 20 years because we demonstrate that the forest is still there, but it's next year and on an annual basis, then we're again using products that exist, applying innovation, tailoring it to new types of climate finance, and bringing adaptation. Because that now, and a very important point is, with insurance, we help to either put or confirm the value. We can quantify then the value because we're putting a price on it of protecting those assets. And now we're using these methodologies that we are developing in order to work with the corporates that have been investing in resilience or that own nature assets. We're talking with some organizations, public and private, that own forests, say utility companies that own forest lands or swamp lands. We're deciding what's the value of these. Do I turn it into a different type of asset? No, you can actually generate revenue, and we can demonstrate by putting a price on the resilience that those nature assets bring. We can then develop insurance. So I'm going to wrap it up with this. We're working in a few projects on what we're calling resilience underwriting. What we want to do is demonstrate then, out of all that we've been talking about, that we can place insurance that accounts for the resilience of the nature-based solutions on the land. So we're working, for example, on a project in the Midwest of the US, in the upper Missouri and Mississippi rivers. There's a lot of farmland, and farmers are moving away from the shores of the rivers because they're either suffering droughts or floods. A lot of these lands have forests. A lot of these lands have wetlands, and there's also levees. So if we can demonstrate that by keeping those nature assets in place, it actually has a resilience value that we can quantify, because if they were not there, not only those lands, but also upstream and downstream, they would suffer from more floods. Now we're making those lands more insurable than others somewhere else. We can put the value on the assets. We can bring those producers into a new climate finance ecosystem to bring them more revenue. But also we can generate more insurable markets to respond to the insurability crisis. Because those farmers, otherwise, they're going to lose insurance, or lose it because it's going to be too expensive, right? So if we can focus the insurance market into those assets, we start creating a new type of market that protects nature and that makes insurance viable.
Thank you so much. Thank you so much. Okay, here's what we're going to do. We're going to take one round of questions from the audience. I'm going to call on Craig first from UNFCCC, and then open it up to a few others. I know that we're running short on time and that some people have to run. So if you have to run, don't feel bad about that. And then Arend, rather than call on you now, I'm going to have you come in at the end and just offer some reflections and responses to help close us out here. Yes, and if anyone has a question specifically for Kathy, because she has to go on to another event, please raise your hands early.
Yes, so we will, it was actually a really great tease, Paula, because we now have Craig. We are inviting him to do a planned intervention from the floor, and then we're going to open up, pick a few questions. Maybe we'll prioritize anyone who's got one for Kathy, and then we'll let her leave. So Craig first, please come and join us, and then we'll open.
Where you can do it for wherever you want. If you want to take the mic from there, however you're comfortable.
Hello, I'm Craig Pettengell. I'm on the delivery team for the United Nations High-Level Climate Champions, Nigar Padarai and Danny Oshpe. I'm the insurance co-lead there. First thing is, some great news. Insurance is now on the official action agenda for the world. Like many of us have been involved on the periphery for years, now insurance is not only in the room, it's at the top table. we have a wonderful opportunity. Last Friday, in the fourth letter from the COP30 presidency, when he specified what the priority areas should be, both for government and for non-state actors, he included 6 key axes. And included in that was the overarching axis of unleashing and enabling accelerators, right? And insurance is one of those. Okay, so we have now been invited to the top table and to act to unleash and enable and accelerate the transitions that we need. So what focus should we have? There's 4 areas where we're doing a lot already. One area where we really need to do more. The first is accelerating transition finance, as Paula was saying, by using de-risking tools that already exist. They're innovative, but many of the beneficiaries, they're innovative, they exist, but many of the beneficiaries have never heard of them. These tools increase the volume and decrease the cost of transition finance. That means we get more clean tech at cheaper prices, we accelerate the transition. And at the Enabling Insurance Breakthrough, we're focused on 3 sectors, 3 key sectors which align with those prioritized by the politicians: the energy transition, decarbonisation of road transport, nature-based solutions, and the shift to regenerative agriculture. We also have the opportunity and are inputting to the Baku to Belém roadmap, taking the 300 billion of transition finance to emerging and developing economies a year up to 1.3 trillion. Personally, I don't think society has a chance of doing that unless we crowd in the private capital using the de-risking tools that insurance can provide. So again, we'll be inputting that. And I think there's also a potential to help get even more pull and support from policy. I think we can put some model documentation into to propose for countries to put into their national development, nationally determined contributions and their national adaptation plans, and also how they could use their country platforms in harmony with insurance to help achieve what they wish to do. I think we've seen some great work in the debt for nature swaps area, using very traditional tools like cat protection and political risk insurance, which have literally, decreased the debt burden of many of the poorest countries by billions of dollars. Just keep doing it. It's a great thing. And the last area is resilience. And I think we've all realized over probably just the last year, I think many of us put mitigation first. We thought we had time for adaptation. I think we're increasingly realizing that time's running out. When you look at the smorgasbord of disaster events globally in many different countries, faster than I think almost all scientists would have predicted. It's now an imperative. We can't delay anymore. And there's been some great work over the years by the Insurance Development Forum, some of the work that Kathy's been doing, but obviously we need to do more. We need to, I think, one, help ensure that all this development that's going on, we're talking $7 trillion of transition finance a year. That's a lot of stuff that's being built. For goodness sake, let's do it in a no regrets way, that it's designed to be resilient to the climate that it's going to face, not the one that we've experienced for the last 20, 30 years. And also help people best adapt to the climate change that they're going to face. Let's apply those risk modeling skills that the insurance industry, frankly, is better at than anyone else. I spend most of my time not talking to insurance people. I've spoken to insurance people for over 35 years, right? I spend most of my time speaking to non-insurance people. And they want to know from the insurance industry, what is the risk? Because they know we know it better than anyone else. So we have to stand proud, stand tall, share what we do know. And we also understand the risk management skills, right? What are the actions we can take to mitigate that risk, to improve it, before you think about transferring the financial cost? So I think we have the example for agriculture. Howden did a superb report for the European Union. I've also seen that same technology applied to wind farms, making sure that if you're developing a wind farm, it's going to be resilient to increased lightning strike and, believe it or not, lower average wind speed. Okay, volatility is up, but the mean's down in some places. And also we can use it to extend insurability, which is so important in so many ways. as has been discussed today. So I think there's loads of those 4 areas are all massive. They're all aligned with what our politicians say we now need. They're aligned with what our society and our families now need. And I'd say to you, let's focus on what we can do. So much of the narrative historically has been about what insurance is not doing so much. Let's be proud. Let's be helpful. Let's unleash and enable the transitions we need and focus on those areas that can really move the needle. Thank you.
Thank you so much, Craig.
All right, Kathy needs to run, but if anyone has a burning question for her, as I said, you can reach out to me. I'll reach out to Kathy and either put you in touch or try and get you an answer. So for the rest of our lovely panelists, I'm opening it up to the floor. Okay, so I'm going to collect maybe these 3 first, let them respond, and then we can go again. We have until half, so we should have time.
Thank you. My name is Judith. I'm working on a platform to scale and speed ESG and sustainability transformation. So my question, I think it's more for Olivier, in terms of the private sector barriers, because we keep on talking about private sector participation. And my feeling is private sector is already overwhelmed. So we need to look to the governments to do more in terms of removing barriers, because investment is not going to come if those barriers keep in existence. So as much as, because we are talking of putting in sustainability linked performance almost. So this performance needs to go beyond just how much have you done to avoid disaster, but how much have you done to promote investment, which will prevent disaster? And what is the regulations which you have put in place to promote investment? Because without that, the risks, especially in emerging in developing markets, will just remain and people will just keep on staying away. So yes, private sector money is very, very important, but the governments need to do more. And we need a new template on how they are measured, which is linked to the sustainability. Thank you.
Thank you.
Hello, I'm Inuri. I am from Sri Lanka, and currently I'm doing some work as my own consultancy. So one question I have is to the host and also the panelists and everyone in here. So as we just saw, like few of us have to rush to other meetings. So just a logistic question. And something I've been asked when I was hosting events for SMEs in Sri Lanka, whether there's a possibility for us to sort of share the contacts, maybe if with permission from the participants, so we can continue the dialogue. I'm sure there are like 50 plus participants here, and I wish I had the option to connect with them. So if we all put our sort of heads together, I'm sure we'll be solving a lot more problems. Then to all of you, the panelists. So I'm from Sri Lanka and I've done some work around like with USA projects, Australian projects, and I have some contacts from there working with different larger processing companies who work with suppliers, etc. So I'm just thinking out loud, like posing the question to you, how can somebody like that reach out to you, get your attention, to, maybe collaborate for maybe a pilot project? Because, countries like us, we had a lot of support from aid projects earlier, but there's that gap. And there were a lot of projects that have been completed, but there's more to be done. So how do we reach out to you, get your attention? And are there any platforms, to continue this work?
Thank you so much.
Thank you. Jeremy Apple, a senior advisor with NatureFinance, but also working with an organization called Nature and People Foundation, which is working on urban biodiversity, which I think is very relevant. So I'm sorry Kathy's gone. Try and catch her another time. This session, given it's Friday morning, has actually, for me, been very inspiring and opened so many vistas that I hadn't thought about. So, thank you all very much, the presenters. But I'd just like to kind of frame three, not paradoxes, but three counterpoints which might just, I hope, enhance the conversation we've had. The three are urban versus rural, adaptation versus mitigation, which has already been touched on, if you like, and corporate versus domestic. So I think the insurance industry can touch on all of those. We've heard about adaptation. In the first presentation we had from SBB, it was very much about incentivizing preventive action, building in sustainability-linked KPIs. Now, for me, this has prompted the thought, why isn't the insurance industry, I know there's a role for policy and regulation, but why isn't the insurance industry at the domestic level also incentivizing me as a householder to do the right things for sustainability? So, for instance, in my household insurance policy, it's slightly cheaper, I hope, if I have a burglar alarm. But it's not slightly cheaper if I have solar panels on my roof or if I've done a sustainable urban drainage driveway rather than paved it all over, which is what all my neighbours have done. So is there a role for the insurance industry to incentivise individuals at the domestic level, whether in cities or not in cities, to take the right action for sustainability? Not something I'd really thought about before this morning, so thank you for that thought. But that's just an example of where these possibilities have been opened.
Maybe just because of timing, I'll give the last person the question and then give it back
Perfect.
to the panel. Yeah, okay, well then we're good to go. Okay, back to
Okay.
So maybe I can start with the first question. So no, you're fully right about this kind of balance between private and public sector. The challenge we're facing in many of our client countries in developing economies is that the government is not always strong enough, and they're facing many other issues. So as I was trying to explain before, I think there are three areas where we're trying to help them create the kind of right environment. What is on infrastructure? You need to have the right infrastructure in place. So when it comes to insurance, about market infrastructure, the right data, all this kind of public good that will help insurance companies and brokers to some extent to price the risk. So access to data is fundamental. And again, looks easy on paper, but quite difficult, particularly when it comes, as I said, to the kind of assets and how to measure them. The second one is very much of this kind of regulatory environment, and it has to be the right environment, particularly if you want to promote private capital from domestic investors, not from international investors, because I think this is where the bulk of the money will come anyway. And the third one is de-risking. And as soon as you try to attract international capital, currency risk is a big one, FX risk. So all that has to be carefully thought. And again, as I said, when it comes to risks like catastrophe risk, which are extremely capital intensive, also you need to make sure that the local market is ready to take on this risk. And sometimes they are not. So there is also kind of timing issue to be carefully thought with government to make sure that you can offer this kind of solutions.
Thank you. On how we connect, I welcome this type of settings that are smaller, where we can, I mean, it's not just the panelists, we have the fortune to be here sharing our experiences, but it's all of us talking in these events so that we can learn from each other. I hope, I'm not too much of a fan of social media, but I hope that it serves us to connect. So please, anytime, reach out with any ideas. I think we have gathered enough experience now to be able to say much faster, like this has legs or it doesn't have legs, or let us think how to make it work. So yes, let's talk to each other. On sir, what you described about at the household level and how insurance should incentivize, 100% agreeing with you. And that is what we're trying to demonstrate. So because we're demonstrating at the micro, at the macro, but what happens at the household level, so that we see the crisis in California, how can we bring resilience so as we minimize risk? So from the insurance industry, basically what we measure is risk. So when an asset is a better risk than another asset. Someone with good health is more insurable than someone with bad health. The insurance industry helped, for example, with sprinklers. If you have a building with sprinklers, and especially if it's in a fire-prone setting, it's going to be a better risk, more insurable than another risk that doesn't have sprinklers. This means one, it's going to have a more accessible premium than the other one because the level of premiums finally reflect the appetite of an insurance company to take that risk in exchange of a premium to then repay if the event manifests in a multiplier of what the premium was. So now we bring this to the community level, and how can we translate this? How can we replicate what we've done with sprinklers in a much faster way and in a community level? It's really difficult to bring the speed that we need. But when we quantify the impact on resilience, we're hoping to influence what I mentioned before, what we're calling resilience underwriting, which is actually to acknowledge it, or recognize, account for that resilience in the assets to make them better risk and more insurable. Concrete case in point. In my former work home, together with the Nature Conservancy, we developed a methodology to quantify the future reduction in losses from ecoforestry management. So our case study was a utility company in California, surrounded by forests. If that forest is ecoforestry management, we manage burns and other measures in order to reduce the risk. So we developed the methodology using the quantifying methods of insurance to say, well, this is the value that ecoforestry management brings in terms of reducing losses. So as we project that value to the future, let's understand what the net present value of it is. And the savings on the reduced losses in the future are the amount of money that we should now be investing today into doing ecoforestry management. So then that property now, and granted, the insurance industry works in 1 year cycles. So in a way, we see the risk long term, but we're only insuring for the next year. But it allows us to see the evolution of that risk. And that utility company with ecoforestry management is going to be a better risk, and it's going to access better premium level. More importantly, it's going to be insurable over the years. So it took us quite a long time, about 3 years for that product to come to market. We're very excited as an industry that a product like that was placed about 2 months ago in California with a homeowners association. And I don't remember the amount of acres protected, but it's a homeowners association that has invested in ecoforestry management, even exceeding the standards suggested by the Forestry Service of the US. That product was placed in comparison with what the premium would have been if there wasn't ecoforestry management. It was about an estimated 39% reduction in the premium and 89% reduction on the deductible. Deductible would be same as our health insurance. If you need to go to the emergency room or you need a treatment, you're gonna pay for a certain amount, like an entry point, and after that you're covered by insurance, same thing. So the deductible. So about an 89% reduction on the attachment point for the deductible. That demonstration is massive for our industry. Now this product is viable. So now we look into the challenges to replicate it, and there's not a tremendous amount of appetite necessarily that is evident to underwrite wildfire in California, and especially with the challenge that you mentioned of the urban wild interface that is coming so close. And so more assets are at risk. What this example helps us is actually to make the business case for the insurance industry, so that underwriting the types of programs that we've been implementing over the years is no longer sexy or good for PR reasons or for our ESG goals or you name it, but it actually is a business case around those assets that are more insurable than others, because the insurance industry needs also to accompany this evolution as a business that needs to underwrite this better risk in order to exist in the future, right? Otherwise, our markets are going to shrink massively. And this opened the doors, of course, to insurtech innovation, which we're suing massively. So there's a lot of dialogue in the US of, yeah, the insurance industry is pulling out of California. Well, some players are pulling out of California, and there's a lot of regulatory and risk reasons for it. But there is an incredible amount of startups and MGAs and other players that are stepping in and demonstrating what are the viable markets. And hopefully that's what's going to help us accelerate. It's our response to the insurability crisis. I hope that very long response gave some ideas back.
Thank you so much. Arend, closing reflections.
Yes, thank you. And firstly, thank you to fellow panelists and fellow travelers who are excited about insurance and looking forward to making it sexy again, as was said. And of course, please do reach out on social media for further conversations. So I think we had some very powerful stories here that really demonstrate that insurance has been at this for a long time. We have a well-established set of solutions. The insurance and reinsurance markets know how to measure and price risk. They've been at this for centuries. And so we need to now iterate on those and start adapting them to these new challenges that we face. But also we've heard a lot about this flurry of innovation. And to your question, Jeremy, about sustainability linked insurance and reinsurance and how that can cascade down to the insured and the policy holders. I think that's a really powerful lever that the insurance market can pull. So if you think about the reinsurance market, the global reinsurance market, nearly $1 trillion of ceded premiums written, and localized they're fairly concentrated, but with clients all over the world. So if they were to institute these sorts of contracts, the impact of that can flow down quite far downstream to the clients who are the insurance companies and to their clients who are the insured. So if an insurance company feels that it's in its interest, commercial interest, because it can get a step down in its premiums from its reinsurer to try to incentivize you to take certain actions, then it'll come up with innovative and creative solutions for how to do that. So that's why I see a lot of potential for this new innovation, in addition to a whole range of challenges that we have to work through. And so we have a set of established solutions. We are innovating at breakneck speed. And so what we really need to do now is to scale at speed. And so I think what we also heard from the panelists is part of the answer lies in connecting insurance to other agendas, whether it's the sovereign finance agenda, the NatureFinance agenda, financial inclusion. I think that's where, from this talk, I'm hoping to see a lot of new ideas coming from conversations that we can have, is how can we connect these dots? What is being done in the digital economy where there might be an insurance proposition that can be embedded? So thank you again to all of you for taking this Friday morning to talk about the exciting and sexy topic of insurance. And I'm looking forward to hearing more about it at the end of this climate week. So thank you very much.